Hi guys, it's Josh here. If you've never invested in the stock market before, then making your first move can be daunting. Chances are you'll have many questions like other people have. For example, what shares should I buy? When should I buy those shares? And what strategies could I use to invest? Well, you've come to the right place because today I'll be talking about 5 things you should know before you start investing. When I first started investing, I spent a lot of time and money making these mistakes, which I could have easily avoided if I could just follow these 5 rules. By following these 5 rules, you have a framework and a guideline on how you invest, which hopefully would reduce your chances of losing money in the stock market and greatly increase the odds of having success. Just a disclaimer, this video is for entertainment purposes only. If you need financial advice, you should seek help from a financial advisor. Opinions expressed in this video are of my own and not those of my employers. Great, now that is out of the way, let's move on to rule number 1. The first thing you should know before you invest in the stock market is to always diversify your portfolio. Diversifying your portfolio essentially means spreading your eggs across many baskets. You should diversify to reduce the adverse effects of one asset on the rest of your portfolio. At a higher level, this could mean investing in a wide variety of assets, such as bonds, stocks, real estate, or even gold. Bonds and cash are a great way to diversify your portfolio because cash and bonds act as a dampener against the volatility of the stock market. Personally, I like to hold some cash. In case the market drops, then I'll have the opportunity to buy more on weakness. However, be aware that holding cash or bonds, too much of it in the long term, is a bad investment, as historically they've returned less than stocks. If you're looking for diversifying in shares, this could mean investing in across different sectors or different countries. If a sector or a country goes into a slowdown or a downturn, then this could mean all stocks within that sector or country would drop as well. By buying across different sectors and different countries, you're essentially protecting yourself in any adverse movements in these sectors or countries. A quick way to get instant diversification is to invest in an index fund. An index fund is a mutual fund or an exchange-traded fund, more commonly known as an ETF, is designed to track a specified list of basket of assets. That basket of underlying investments could include stocks, some going into the thousands. For example, the Total World Fund, stock ticker VT, is designed to track stocks in a wide variety of countries, as well as a wide variety of sectors. VT is as diversified as it gets when it comes to stocks. This means that when you buy a share in VT, you'll have a good level of diversification from the get-go. One thing to note when going shopping for index funds are their fees that they charge. Management fees could slowly eat up into your returns over the long term, so you should be careful at how much fees you're paying in the long run. The second rule of investing is to always invest for the long term. The S&P 500 has historically returned about 7% over the past 100 years, and the NZX 50 has performed about 8% over the past 70 years. In the long run, you can expect those types of returns. However, in the short run, the market is volatile and you might not achieve those returns. In fact, you might even have losses because the market can go down in the short term. This means that if you want to sell out of your stocks at the time and you recently bought in, you might be selling those stocks at a loss. To make sure that you can stay in the market for the long term, you should only invest money that you don't need, as well as setting aside an emergency fund in case those unexpected expenses happen. Rule number 3. Don't try to time the market. Timing the market essentially means trying to buy when the stock market is at its all-time low and trying to sell when the stock market is at its all-time high. In 2015, I remember there was plenty of doom and gloom about an imminent slowdown of the global economy because China's economy was slowing down. There were many people that sold out of their assets and waited on the sideline holding cash, only to realize that the market has continued to rally since 2015. Since December 2015, the NZX 50 has returned about 70%. In short, don't try to time the market because the market will time you. Instead, you should dollar cost average. Dollar cost averaging is a strategy where you set aside money to invest across a period of time consistently. For example, in my upcoming public portfolio, I'll invest $150 a month or about $5 a day. This means if the market goes up, I'll make money, but if the market goes down, then I have opportunity to buy more stocks at a lower price. The fourth thing you need to know is to always do your own research before investing. If you're investing in individual companies, then you need to know how the business makes its money, how the management team is performing, and the direction of the company. You should also pay attention, most importantly, to the valuations of the company. Researching takes time, and even if you spend a lot of time researching, that doesn't guarantee that you'll make a return. But if you do your own research, then you have confidence to buy when the share price is going down, and to sell if the share price is overhyped and overvalued. If you're a beginner or you simply do not want to do any research, then I have good news for you, because investing in an index fund takes no research whatsoever, and you'll know that in the long term you'll achieve those 7 or 8% returns. You won't achieve phenomenal returns like Warren Buffett did, but you'll do better than 90% of the people out there. The last thing you need to know is to use a right broker that suits your needs. Broker fees can eat into your investment returns in the long run. Things to look out for in a broker include the transaction fees, any account fees, and the types of products that they offer. In my last video, I talked about Sharesies and why it's the best platform for my purposes. I have attached a link in the description if you'd like to check that out. If you're just starting out and you're thinking of just investing in index funds, in which case Investnow is a great platform to use. Investnow doesn't charge any account fees or any transaction fees. However, you'll still have to pay the standard management fees on those funds that you're invested in. That sums up the 5 things you need to know before you start investing. I hope this video is helpful for you to develop your own investment strategy that will greatly increase the odds of your returns. Until then, take care.